And at the end of it, he was like, you could pay me full freight in cash, or I'll give you a 50% discount if you send me Bitcoin or Ethereum. And this is like one of those like Mr. Miyagi type moments.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Ben, thank you so much for joining me. And before we get kicked off with your introduction, I do want to talk about the fires, because you live in LA. You were affected by the fires. So could you just tell me about that journey, that experience? Because I mean, the fact that this happened, 15 days ago, and now you're here talking about, we're going to talk about work today, is just incredible. So could you kind of take me through how that's been for you?
Yeah, well, first off, thank you, Andrew, for having me and for the welcome distraction of being a guest on a podcast, being on the other side of the table. I don't have that opportunity often, so it feels good to share my story. Yeah, I've been in LA with my family now for 5 years. My wife and I, we have a dog named Otis, and we have a 10-month-old daughter named Theodora. We've been in Venice Beach for like the last 5 years, and we've been trying to move out of Venice as we look to grow our family and explore another neighborhood in LA. It's very competitive, tough to find, houses within budget. We wanted to rent, not even purchase, and it was still insane. You would see something pop up on Zillow and there's 50 applications. So we've probably spent the last year trying to find a place, and we finally landed one in the Pacific Palisades, which is a beautiful neighborhood, lots of parks, suburban feel, great public schools. We're like, okay, this seems like a good place to lay down roots. We got the place. We packed up our boxes. We spent 5-6 days really packing, organizing, and then ultimately moving to the Pacific Palisades. And so we moved in on January 2nd. And then on the morning of January 7th, my wife and I were so happy to be in this place. We had our nanny come to take care of our daughter for the first time in the new home that day, while my wife and I went to work. I went to go to a co-working space in Venice. She went to her venture capital firm's office in Ocean Park. And we received a text message with a photo of large smoke clouds and flames from our nanny who had just put our baby down. And she was like, what should I do? We told her, we're like, get out of there. And so I had to instruct her on how to install the stroller that converts into a car seat to get our daughter in. But we didn't know, like, we would never see our home again. We thought maybe there was just like a house that was on fire or something like that. And it's all happened so quickly. And, I've relived this moment in my mind 1,000 times now. But we told her to evacuate first and foremost, get our most prized possession out of there. Our baby, my wife fortunately brought our dog to work that day. And so our nanny, total hero in this moment, give her the Purple Heart. We met in a Whole Foods parking lot. And then we saw like the fire continue to expand. Thought about potentially driving back into the Palisades to try and grab some precious belongings or essentials. But apparently it was totally gridlocked and you couldn't get in. And then even worse, you could potentially get stuck and unable to exit because the Palisades only has very few paths in and out. And then we heard like stories of people having abandoned their cars. So we made the decision just to flee. And we drove down. Fortunately, my in-laws are in San Diego. So we had a place to, like a true home to soft land into. And, I'm naturally an optimist. I was like, oh, our place is going to be fine. We're in like the heart of suburbia. Like there's no way like it's going to just eradicate this home. And we got a call from our owners. And they were on the website Nextdoor, where people were kind of roaming the Palisades and taking footage. And they were like, hey, we saw a video of someone on our street, and we froze the frame as they canvassed over our house. And it was like totally burnt to the ground. One funny quick anecdote was that all the appliances were new in this home, except for the dryer. And the dryer was a piece of shit. And so I had to dry things multiple times. And so I tried to dry something overnight and it was still not dry the morning of. And so I turned it on again. And before I left the house that morning, and when we looked at the photo, the only thing standing in the house was the chimney and the dryer. So one day, maybe this weekend or the following weekend, I'm going to go back to the Palisades and see if I have some very, very dry clothes still in that dryer. So that was one slightly funny part of this whole experience. But yeah, it's been brutal having a tragedy like this happen. You think about all your family heirlooms. Like I had stuff from my grandfather and my grandmother. My wife had her wedding dress and stuff she had received from her grandmother and great grandmother. So you reflect on all those things. And like we had been taking Polaroids of our newborn for her entire first year, and we're going to make an album. Like those are gone. Annoying logistical items like social security cards and passports, and you just think about you're grieving for one, the neighborhood, two, all our belongings that are now gone, needing to rebuild everything, and then once you're kind of past the grieving stage, or like you're still kind of grieving, you think about all the operational logistics of buying clothes and like figuring out what you owned and like getting everything set up for insurance and personal property and FEMA and all of that. It's just a lot of work that actually has been a useful distraction. And then now, like probably 15 days out, we can slowly start to shift our gaze towards more life planning. And there's a lot of complexities. Like this is the neighborhood we wanted to be in. So where do we go? Like, how do we get back there? There's no inventory of homes in most of LA because everyone in the Palisades and other adjacent neighborhoods had to flee. So we're working through all of that now. What I will say is the great silver lining is that our community, family, and friends came out in spades to support us. We have received an overabundance of rogue Venmo, random people from my Instagram that I haven't spoken to in 5 years, sending me $100. People buying me an Amazon gift card, sending me shoes, like, and then the book collection. We requested books from our friends and family, and we've received the most incredible selection and library of baby books and adult books. And so that's been really heartwarming just to see the level of support and love from family and friends. And one final thing, because I know people want to talk crypto, but I find solace in this like little parable that pretty well known, but it's called "Who's to Say What's Good or Bad?" And this like ancient farmer, like he loses a horse. His horse runs into the wild, and his neighbors are like, "Oh my God, I'm so sorry. How are you supposed to take care of your crops, without your horse?" And he's like, "Who's to say what's good or bad?" And the next day, the horse comes back with 4 additional horses. So now he has 5 horses, and they're like, "Oh my God, you're the luckiest man alive." And the farmer says, "Who's to say what's good or bad?" And then his son is trying to break in one of the wild horses, and he falls and he breaks his leg. And they're like, "Oh, so sorry, like your son hurt his leg." And then the next week, there's a war, and they recruit all the young men to go fight in the war, but his son is excused from the war because he broke his leg. And so it can continue on and on. So I'm trying to apply that lens. Like, I don't know what the future holds. I don't know why this happened. It's miserable in the moment, but I think down the road, I'll look back at this event and just see, how our family coalesced and grew tighter. Our friends and network supported us, and who knows what adventure it'll put us on. So who's to say what's good or bad?
Awesome. But Ben, no, thank you. I mean, it's just such a crazy tragedy. And, I think it's really important that, you share that story because it's so unusual for people in the States to kind of experience this. And, no, I appreciate you digging into that. And yeah, it really puts everything into perspective. But I also appreciate your mindset of like, hey, you know what? Having this conversation will be a great distraction. So I'm happy to do it. So, thank you so much for doing that. I really appreciate it.
Of course. Yeah. Ready to talk crypto. I've been, when I'm not doing stuff, I'm thumbing through crypto Twitter. There's a lot of action. So
Perfect. All right. So on your intro. So Ben, you are the founding managing partner of Senius Capital. Did I say that correctly?
Correct.
Wonderful. Which is a crypto fund of funds. You have over 30 fund investments, both across liquid and venture. And you also participate in direct investments as well. And you have this awesome podcast, which is focused on crypto investing, called Senius Studio, which is it's on Spotify and YouTube, or just Spotify?
Spotify and Apple.
Okay, great. I'll link that in the description. But incredible background. I'm really excited to dig in here. But before doing all that, could you tell me, how did you get started into the crypto world? Like, what was that first revelation for you that made you realize, okay, crypto is a place that I want to play in and I want to spend my time in?
Yeah, I'll try to condense a long story, but I went to Vanderbilt shortly after graduating in 2015. I was still in test taking mode, so I wanted to get the GMAT done. This was back when going to business school was a more common path, and I always did well in the verbal portion of standardized tests, not so well in the math portion. And so a couple of weeks leading up to the test, I knew exactly where my deficiencies were and what I wanted to get score-wise on the test. So I searched best GMAT math tutor in New York City. I found this guy who had nothing with 5 stars, glowing reviews, but his hourly rate was exorbitant. And I was like, you know what? I have 2 weeks leading up to this test. I've been busting my ass studying for it. Maybe it's worth the money. So I met him. He was a retired hedge fund professional who had made a ton of money and had since wanted to focus on tutoring kids in finance and math. And it was a very intense 2-hour training session. And at the end of it, he was like, you could pay me full freight in cash, or I'll give you a 50% discount if you send me Bitcoin or Ethereum. And this is like one of those like Mr. Miyagi type moments where it's like he clearly said it to spark an interest, because I'd really only heard it via the Silk Road. Glad to hear Ross is out. And kids buying fake IDs or illicit substances during college using the Silk Road. And I never heard someone who I viewed as sophisticated or intelligent reference Bitcoin or Ethereum. And so then I was very inquisitive and started asking him questions. And he's like, how about on our next session, we'll spend some time on crypto. And he was my crypto mentor. And for whatever reason, I think partly because I was looking for something new and interesting to sink my teeth into, because I was just a consultant at that time. And it resonated. So I started buying Bitcoin and ETH with each of my paychecks. I managed to convince my family to put a little bit of money in individually, got some friends in, and over the years just became obsessed with the space. And I never really knew how to participate because I had no interest in being a trader, and I wasn't technical. So I really never thought how I could fit in. So I worked in consulting, then I migrated to tech. I had my own side hustle, e-commerce startup. And then in 2020 with COVID, I saw the rise of DeFi, was reading about NFTs and social tokens, and shout out to you for being one of the first bright minds touching on NFTs. I remember devouring everything you wrote about NFTs way back in 2020. So you were way ahead of the curve. And, I was like, you know what? There's enough meat on the bone here that it's worth it to go all in. And so I quit my job. I didn't really know how I was going to participate, but I did know that I wanted to invest my money more thoughtfully because I was just pretty much long the majors, which in hindsight is probably the best way to have invested, unless you were to catch, a random flyer. But I was like, there's other ways to participate in the asset class. And there were people who had far more alpha than I did in terms of trading, or in deal exposure. And so I reached out to my brother. We literally Googled crypto funds like that are out there, and we started reaching out to them. And initially we were planning on investing ourselves into a basket of funds, and then started socializing the concept to people in our network. People were like, oh, like if you put together a vehicle, like, can I give you some money? And like, I'll invest alongside you. And that was kind of the light bulb moment that people were willing to pay for a portfolio of diligence, diversified asset or active asset managers in this space. So that was kind of the story and the genesis of what is now Senius Capital.
That's amazing. Okay, so it really spawned from you and your brother just wanting crypto exposure in a professional managed way, looking at your own options, whether it be venture funds or liquid funds. And then from that process, people are like, hey, what are you up to? What are you interested in? Conversations. And you're like, oh, well,
really interested in crypto, et cetera, et cetera. And then they said, hey, can we participate? Was that like how the fund of funds
Yeah,
essentially started to
that's
be?
exactly what happened. And I never worked in finance, neither had my brother. We had never managed anyone else's capital, so it was extremely grassroots. Like we had to learn what a limited partnership structure looked like. We had to figure out like what are all the different service providers' roles? What do they do? And fortunately, I think our network trusted us as good stewards and they wanted to bet on us and bet on the space. And like, we weren't saying like, look, we have all the right answers. Like, that's why we picked the name Scenius, because Scenius means a collective intelligence. So our thought was, listen, trust our instincts to find the right investors and we'll pool them together. We'll do all the work and we'll make it a one-stop shop for you to get exposure to a broad range of investment strategies in this space. So we started off with 3 million in outside capital, and now we've scaled to north of 30. And we have vehicles across private venture fund of funds and liquid fund of funds. And we've done a plethora of angel deals and have done a few other direct deals and SPVs.
That's amazing. Okay, so the fundraising process, because you were doing your own research, you were doing your own diligence for your personal purposes, and then when you mentioned to your network, were these all people that were, how would you classify them? Or were they high net worths that were retired? Were they folks that were maybe consultants or in tech or something that had some capital themselves? Or how would you classify your type of LPs that were attracted to this?
Yeah, I didn't know I didn't know a single family office. I didn't know a single institutional LP. I didn't know how that world worked. So I was like, okay, who can I go to? I would go to my dad's friends. I would go to friends of mine from college and speak to their dads or moms. I would meet random people at crypto events or investing events. My brother was doing the same thing. So bit by bit, we would refine our pitch, speak to people. We brought on some advisors who helped educate us on like how to diligence specific strategies. They would join a lot of those calls. They would teach us about portfolio construction. We did a lot of work to kind of figure out how to build this. And it was like kind of building the plane while flying. And once you get a few LPs, they tell their friends it's an exciting investment. And now I think we have over 130 LPs.
Wow.
So, I'm proud that we have so many people who have trusted us, and we're still, we're 4 years in now to running it. But, it's a blip in terms of some of these other asset managers have been around for, 5 to 50 years. And so these people trust us. We do the work. We communicate. With the way we describe our shop is we're kind of like the mom and pop restaurant where the dad is in the back cooking and the mom is up front as the host and the server, but everyone's kind of doing everything, and you're going to get high quality service, and we're like really treating this thing hands on. You're not going to be pawned off to someone else who doesn't have the same love and dedication to the business and the product.
That's awesome. And also you mentioned the age, you're like you've 4 years, 5 years, et cetera. But in crypto, I mean, that's like, I'd say that the institutional interest in crypto really only started in 17, and very few folks actually were deploying back then. And then 2020, 2021, that era was kind of the more, I guess, early adopter institutions that were entering. So, you say like, oh, it's only been X amount of years for crypto. That's very experienced. That's like a lot of history right there. Which is cool to be at the start of like a dawn of a new market.
Yeah, we describe we've earned our antibodies. Like in crypto, you can kind of tell who's been around across cycles. They're less phased by day-to-day market movements. Like you just have your eye on the ball. You're just not, trying to get distracted by the next shiny object. And you're just like, okay, I know the general trend where everything is going. I know I am correct. This is truth. Just find ways to capture this opportunity and don't get short-sighted. Don't take any risks to try and capitalize on a small moment in time. Just stay focused, stay dedicated, and just don't take your eye off the ball, and you'll do just fine.
You mentioned that early on you and your brother were Googling, crypto fund managers and reaching out that way. Was that the primary way to connect? Was just through social media and Google and, kind of finding these managers, or was there some other source that you were using to kind of connect with all these early managers?
Yeah, there were databases back then that we subscribed to. None of them were that excellent. What I found back then that is different now. I know most of the managers in the space now, so I could get in touch. But back then, even if you were trying to invest only like a couple $100,000, you could get in front of anyone. All the managers, like the top names in the space now, were taking calls, and now they have robust IR teams. If you're trying to write, a $200K check, they're probably not going to take your call. If you're trying to write maybe a $5 million check, they would take your call. So like that's been a kind of a change over the last few years. Yeah, like one thing that we did that I thought was smart was we're not like really competitive with the other fund of funds in the space. Like we're just trying to we're all trying to grow the pie, and if the space grows, we're all going to win. So becoming friends with the other fund of funds, other active LPs in the space, whether they be institutional or high net worth or family office, and developing rapport with them has enabled us to maintain a flow of info that enables us to meet managers early in their journey, solicit a lot of, I'd say, less obvious data points on managers. Because when you talk to managers, they're going to tell you exactly what you want to hear. They're going to give you references that tell you exactly what you want to hear. But when you have a deep, robust network of other LPs, other GPs, founders, operators in the space, you can collect a ton of info and data points that enable you to really assess a manager's mettle and reputation. And so like that, networking with those that are not necessarily going to invest in Senius or that we might not invest in because they're another allocator, that has been a great source of just information gathering.
That makes a lot of sense. So in these early days, so how would you categorize the different strategies that these different managers were participating in? Because I don't know, it seems like early 2017 era, it was a lot of liquid funds, and then a lot of those actually ended up blowing up. 2021 it felt like a lot of venture. Now we're seeing a broad range of everything, but that's also coming from my perspective. I wasn't talking to tons of funds, so tell me from your perspective, did you have a strategy going into it early days where it was, okay, we want more liquid, we want more venture, and then depending on that, how would you decide, okay, this manager is doing something differentiated, therefore we want to participate? Or what was that like? What was that process like?
Yeah, it's a good question, and one that's constantly evolving in terms of like what's the right structure for a crypto fund, right? Because it is, even with like fair launches now and community led projects like Hyperliquid, it kind of an Echo like kind of changes the dynamics of what a venture fund is for, how a liquid fund should be operating. So back when we were starting, we thought that a lot of the long bias fundamental liquid token hedge funds were effectively VC funds with better liquidity. So our thought was, let's invest in those, and maybe we'll add a couple lower beta strategies to soften some of the volatility. And that way LPs in our fund could capture the asymmetric upside potential of crypto while being able to exit some of their positions so they don't have to deal with crazy swings, and it's pretty liquid. That was our first strategy. Now we've launched this year a fund of emerging manager VC funds focused on smaller VC funds, and can touch on why maybe later in the conversation. But a lot of those are 5 to 10 year close-ended funds where they're calling capital over 2 to 3 years as they see investment opportunities. Some of them are even deploying into liquids, either spot or discounted tokens straight from Foundations OTC. I see every single strategy. I see some open-ended structures that are then doing side pockets for private deals, 3-year lockup, open-ended funds. So what I've seen a lot of funds deal with is like, hey, we know crypto is kind of like a hybrid world between venture and liquid. And so we're going to try and create a vehicle that's optimally suited for this asset class. But the reality is the larger LPs, institutions, they really struggle to allocate to those because it just doesn't fit within one of their traditional buckets. Venture is meant to be close-ended, capital is drawn down, it's not as volatile, and open-ended is meant to be, more liquid, not dealing with quirky side pockets and valuation. And as a result of that, I've seen way more dedicated strategies where they're kind of branching out and falling into traditional hedge fund wrappers, traditional venture fund wrappers. And then within like venture, you've seen like some kind of reduce the fund life given just the liquidity of tokens and a lot of their investments having a token component to them.
Yeah, I think it's funny that the institutional allocators oftentimes they will not participate because it doesn't fit in the bucket nicely for them, and it's weird in the sense of, hey, this is, they believe in the ecosystem. They're like, we're really bullish on crypto. We want to get allocated, but because it doesn't fit neatly into our spreadsheet, it's like we don't want to participate. It should look like XYZ, which it's like crypto is an emerging ecosystem, emerging market. It's like you can't really have these strict rules at such an early stage. Maybe in 10, 20 years from now, it's much more likely. But at this stage, as you mentioned, there's hedge funds look like venture funds look akin to hedge funds. So it's kind of a odd world. Have you noticed being a crypto native player that provides a source of edge for you because you don't really care necessarily about the structure? Well, you do care about the structure, but it's not like you don't fit neatly into A or B category. Therefore, we can't do this.
Yeah, I think being crypto native, understanding the culture, understanding the tech, being able to probe, I think like enables us to really assess like how well does this manager understand what they're investing in. That's definitely helped because I actually think you can like wipe out 50% of the managers who just don't have enough knowledge where I'm like truly impressed by how much I understand the category or where things are trending or developer momentum, blah, blah, blah. I also think running the fund of hedge funds for 4 years has enabled us to be much better venture fund investors because in crypto, the hedge fund world and the venture fund worlds are much more concentric. And knowing how to diligence a hedge fund influences how you diligence venture funds. Everything from operational due diligence, how do they move assets around, how do they think through counterparty risk, to how well do they think about exiting liquid token positions. If half of your portfolio is liquid within 3 to 4 years and you're a 10-year fund, you're probably going to deal with a number of different market cycles. So how do you think about locking in gains, staking, and then potentially sacrificing liquidity? How do you distribute? How do you exit positions? How do you think about DPI? Do you have plans on how you actually do that? Are you doing it on gut instinct? And so those are things that we've spoken to so many hedge fund managers and really understood how liquid token markets function, that beyond just the operational due diligence and the initial investment due diligence, there's a whole second half of being a venture fund investor in crypto, which is how do you exit? And that's where you need to think like a hedge fund manager. And they're two very different skill sets. Like one person who understands where, scaling technology is going may not know how to exit effectively without, harming the project and without just hitting like market sell, X tokens. So I think through that, we've been able to really dig into some of these venture funds that other LPs may not be able to do as well. And then on the flip side, by understanding where all of the venture trends are heading, we see where there's innovation, where entrepreneurs are building, and the implications of that on liquid tokens. And so the last, I'd say, 18 months have been a little weird in that a lot of GPs on the hedge fund side have consolidated around the majors, as that's where institutional flows were going. That's typically where bull markets start, is in the majors, as there's a flight to quality. But now, probably since Trump's election back in November, I'm seeing a very wide scope of investments that these liquid token funds are making. And that's because there's so many different liquid token projects that have come to market, some of which are venture backed, some of which were organic. And so I think we're going to see much greater disparity in hedge fund performance in the next 24 months than we've seen the previous 24 months. And that's where I think you really need a trained eye for which hedge funds not only understand markets, the macro overlay, how to leverage all the derivatives and instruments that are available, but also, do they understand where the tech is going? Do they understand how capital flows specifically throughout crypto? Because you might think, oh, like this makes total sense. Like DeepIn is a tailwind. Like it's one of the only areas within crypto that has product market fit or makes sense to non-natives. But DeepIn has lagged. If you were to compare that category to DeFi or AI or DeSci, so where does it make sense to allocate? Is it fundamentals? Are you trying to be the fastest horse catching a new narrative? Are you doing something technical? So that's where you really have to drill into like what these managers' edge is. It doesn't necessarily need to be like we understand the tech. They could be like we understand market sentiment or signals better than others. They really need to hone that category. So that's kind of, and I know that's kind of a winding answer, but
No, that was
covers
great.
how understanding hedge funds influences venture and venture influences hedge funds.
So, building off that, this is going to be kind of a bad question, but I have to say it. Have you noticed a performance difference or a large performance discrepancy between venture and hedge fund? And again, we just literally went through how they're similar in many aspects. In many ways, they're different. But have you noticed a big performance difference, or broadly speaking, has it been similar?
Yeah, I would say truly measure venture fund performance, because even the oldest funds
Yeah.
have not even exited all their positions. The oldest funds are like 2017, 2018, but the majority of funds are 2020 to 2023 vintage. So they're so early in their fund life. Every fund has different valuation policies. Like some funds, if they have a project they invest in launches a liquid token, they still market at cost until their project is totally vested, or that project is totally vested. Other funds may have some mechanism whereby, as a percentage of tokens unlock, then they strike NAV based on what the spot price is to a discount, and then like apply a discount to it. So it's really hard to measure them apples to apples right now, given different valuation policies. Some funds have a liquid component to them, which enables them to have seemingly higher marks earlier in their fund life because maybe they bought BTC or Sol and they're a venture fund. So those like might be slightly unfair. So it's very difficult apples to apples comparison. I do think liquid funds, there's less competition. On the venture fund side of thing, it's much easier for allocator capital to flow into the space. So they've historically preferred venture because there's no monthly marks, lower volatility because everything is supposed to be marked at cost. So that's where capital has flowed. And so I do think it is much more competitive. On the hedge fund side, it's very difficult to fundraise capital, especially if you're a higher vol strategy. And so even like the best funds have like, 100 to 250 million max. A couple outliers like Multicoin and Pantera that are north of $1 billion. But then for them, it's also much more difficult to manage those and to size into positions. There's very few projects. So then at that point, does it make sense to just buy the majors yourself? So I can't give a straight answer. And also, like, there's so many different strategies within the hedge fund world. Like, there are some funds on the lower beta side that are doing yield farming or market making or trend following momentum that have generated exceptional risk adjusted returns and Sharpe ratios that would make traditional allocators foam at the mouth. And they're returning, let's say, 20 to 35%. But they might have a share class where you can subscribe in BTC, ETH, or SOL. And so for us, we're invested in one of these low beta market neutral strategies where we're in their BTC and ETH denominated share class. We own the Bitcoin beta, and then we just earn 30% more BTC net of all fees.
Wow.
So compare that to most funds who have underperformed BTC by a landslide, or venture funds that have not issued that much DPI yet. Maybe they will, but it's a tough apples to apples comparison, I would say.
It's very interesting. Okay, so have you noticed for when you're talking to different managers, does the edge normally lie in some quantitative insight or skill that they have? Maybe HFT or some, I don't know, some very quantitative focus that they're doing or participating in, or is it more qualitative that they are in the trenches, so to speak? They're in the chat rooms, they feel the narrative, they're on social, they're talking to folks. Have you noticed that? First of all, is that the case? Are there a lot of quantitative folks that are participating versus qualitative? If so, is one outperforming the other?
Yeah, on the quant side, I think low latency, having huge engineering teams to do high frequency trading and market making, you're able to generate exceptional returns. And a lot of those teams are ported over from traditional finance, where they were doing that in traditional equities or whatever market they were participating in, and have ported over that tech. That's one strategy that a crypto native upstart is really going to struggle compared to a team of 150 devs doing this. That's swinging around an insane amount of volume every day. I think on the liquid side, the teams that had the most edge were deeply understand crypto and how capital flows throughout the space, but then they really understand macro and how things like liquidity and inflation and NASDAQ and looking at the ETFs, how all of that trickles down and implicates the liquid token markets. And then I find the best managers have interesting ways of expressing those theses. So it's not just like, I'm going to buy Bitcoin, but I'm going to put on this interesting trade leveraging miners or options or buying this, discount to NAV for a Grayscale trust, like some way of expressing a trade where they're able to eke out additional alpha without taking on too much more risk. And I think those are the managers who are thinking through trades and not just like long an asset because it's obvious. They might have that too, but they're eking out additional alpha by finding creative ways of expressing trades. Those, I think, are the ones that are able to just generate top performance month after month, year after year. And that's what we look for. It's not just like, did you find this AI token before everyone else just because you were in the right chat group? Maybe that's your edge, is like you just are in like all the right, you're in the cabal chats, but you need to be able to prove that you can do that repeatedly and consistently, or you have a broader understanding of how to manage a portfolio, and you do so under the right risk parameters, and you're not going beyond the pale to try and capture an opportunity that takes on too much risk as a result.
How do you think about portfolio construction within your own investments? Because crypto's global. There's no specific geography really that crypto is dominant in. I mean, you could argue. I mean, America's probably going to end up actually for the next few years be pretty dominant, but broadly speaking, it's pretty global, and there's so many different strategies as we were just talking about. So how do you consider portfolio construction within your own firm?
Yeah, maybe first I'll touch on liquid and then I could move to venture. On liquid, our perspective was that if people want exposure to crypto, they want some of the beta. They may own BTC, but they don't really want to be trading BTC. They might not even own Sol or ETH. So we wanted to give them strategies that included some of like the majors, but then also some like the altcoin picking, and then interesting strategies on top of that. So whether that could be creative ways of shorting, whether that could be creative ways of expressing trades, like I just referenced, whether that's like the market neutral strategy I mentioned, yield farming, etc. So all in all, our portfolio construction is we want to capture 80% of the beta, but then mitigate some of the drawdown. So that's why we have some of those protective strategies in there. So overall, when you look at our fund's performance, 2-year timeline, 3-year timeline, 4-year, 5 years, so we want to be doing this forever. It's like, okay, they were a good source for risk-adjusted returns, and you weren't as afraid of some of the counterparty risks, some of the single manager selection risk, the business risk in crypto, because we're diversified in a broad basket of like 8 to 12 funds on the hedge fund side. So things like an FTX blow up or a Genesis blow up could have de minimis impact because all of their managers are using various different counterparties, and you have, diversity that way. That protects it. Plus you're diligencing to make sure that they have good procedures in place for those exogenous risk factors. That's on the hedge fund side. On the venture fund side, we evaluated the landscape of other fund of funds and what we thought was a unique product to offer. And so for us, what we thought was distinct in the market that offered maybe LPs that already have exposure to the Spermians or the Multicoins or the ParaFis was a basket of tough to source, small fund one and fund twos. And so our construction there is we want to make sure we're diverse across geographies. We want diversity across ecosystems, and we want diversity across like coverage groups or sectors, gaming, consumer, DeFi, AI, etc. So we look for managers that our average fund size is 30 million, that have a demonstrated edge, typically in some means, whether that is Solana or it's in gaming or something like that. We really want to make sure that they have edge there, because our thought is these managers, like your average LP, is not going to have the time or the energy or the wherewithal to source and find and diligence and assemble a portfolio of these different strategies. But for us, we thought, okay, if you were to look at any type of analysis, smaller funds on aggregate tend to outperform larger funds. Yes, there's greater disparity in performance, but that's like why you're hiring a fund of funds to try and find the best. And we roll it all up into one package. And so you could come to us, you get access to a totally different crop of managers that you otherwise would not have access to. Again, maybe you have a couple LP checks already written to other venture funds. So you can get exposure to these funds. It covers the entire asset class, and you get to learn about up and coming managers, because maybe one day you'll want to go direct, and we will gladly facilitate that. So that's kind of our thinking is we're in the trenches, we're in the weeds. We find out about managers when they're launching, probably within a month, just via our network and communication. And we try and make it a very, very simple product for LPs to get exposure to the group that we think covers the industry, is diverse, and will hopefully generate outsized returns net of all fees.
That's very cool. And this, what you're referencing right now, is a product that you mentioned earlier, where it's like, hey, we just launched this. You said 25, or was it early last or late last year?
We launched it in January of 2024.
Okay, very cool. And so it's emerging crypto fund managers
on the venture side.
Venture side, very cool. And you're talking about the sourcing. how are you able to, you said your network is where you source most of these opportunities, but is that from other managers? Is it from founders? Is it, how are you sourcing these early funds? I'm sure a lot of them are just reaching out to you. Hey, Ben, can we talk? But how else are you sourcing them?
Yeah, I think because I've been in the space for a while, I receive just a lot of inbound on Twitter and LinkedIn and Telegram. The other LPs in the space, like we all like share notes and make introductions as we receive them. And then a lot of GPs are like, hey, like my friend is spinning out from this firm. Would love for you to chat with him. So that's kind of how it flows. And then similarly with founders, like I'm an angel in a fair amount of companies. And so as a result, I'm just in touch with founders and operators and just hear things word of mouth and then, going to events and conferences and things like that. So it's still a relatively tight community. I feel like it's like I'm able to keep my finger on the pulse and there aren't too many that slip through the cracks. But I think it's just kind of, being obsessed with, like, that's one of our edges. Like we only do crypto. If you ask me anything about healthcare, if you were to ask me anything about biotech, if you were to ask me about SaaS, I know literally nothing, but I just live and breathe crypto. And that's an edge over groups that try and cover everything.
Totally. All right. So the diligence process, I know that obviously this can differ between a venture fund in this, specific area of focus, or a liquid fund in this strategy, or kind of that yield fund you were talking about. So I get that there's no one size fits all, but broadly speaking, could you talk a little bit about your diligence process?
Yeah. I'll try and group together venture and liquid. They both have unique components to them, but in basic terms, we have initial call, we review a deck, we try and ask, general questions. What was the formation of the firm? How did the team get to know one another? What's your history in the space? What are some investments you've made? What's your thesis, your strategy? What's the organizational structure? Things of that nature. Then if that call goes well, it's interesting. We'll have another call where we dive deeper, probe, like after reviewing their materials, we'll probe deeper to try to really assess how well they understand the topics that they claim to, and just like try and get to like a kernel of truth, whether they're excellent or not. And then if that step goes well, then we'll go deeper. We'll start, back channeling among our different contacts in the industry to get, a gauge of their reputation and collect those data points I mentioned earlier. We'll get introductions to their service providers. We'll verify all those relationships with a suite of questions. We'll have them fill out our due diligence questionnaire. We will speak to other LPs that are investing in them. We'll do professional references. We just try and get a ton of information. We'll bring on our advisors to collect more perspectives on our end, who we then debrief with. And then if we think all of that looks good, then we'll start writing an investment memo, figure out where the gaps in our knowledge are. It's like, we've had multiple calls with them, but realize that we're missing this piece of information. We'll typically have a dedicated Telegram chat where we're just communicating back and forth real time, just to try and ensure we really understand every single detail we can. And then if all goes well, then we track on the venture side, for example, we track every single underlying position we have. So we know all the funds we're invested in. We know each of their positions that they've made. And so we look, okay, we have tagged them across, all right, this is an Avalanche position. This is a Bitcoin position. This is Solana. This is, an EVM L2, blah, blah, blah. Then we say, okay, this is a gaming project. This is infra. This is whatever. We tag that. And then we can look and aggregate. It's like, all right, what is our capital exposure to each of these ecosystems, each of these categories, each of these stages? This is seed. This is later stage, blah, blah, blah. We're like, does what this fund is doing compatible with our portfolio? And are we ensuring that we have better diversification and getting exposure to things that we think will drive outside success? And if that is true, and all those other checks were done, the investment memo makes sense, and we're aligned, then we'll make the investment and try and size it appropriately. And I'd say relatively same process on the hedge fund side.
Have you discovered correlates of success with different managers? Like, for example, on the venture side, okay, one correlate of success, and I'm just throwing stuff out there, but one correlate of success is that the managers that often have the best access are outperforming. On the liquid side, the managers that have former TradFi experience that maybe are former traders, they're outperforming. I'm just, again, examples. Or is it more of like, actually, it turns out that when the funds deploy within the market cycle, that actually has a big impact, which I'm sure it has some impact. But anyways, have you found that there are correlates of success, or is it still pretty difficult to nail those down?
Yeah, I'd say I definitely, our venture fund of funds is only a year old at this point. So I don't have long-term data points from us actually investing in venture funds that I could point to, but I can see early indications of who's doing well in our portfolio and other funds that we're tracking. And I do think there's some merit in having some specialization. I'm not saying you need to be, very narrow focused, but generally, at least having an expertise and like we're trying to lead deals in this area, we might do like if there's a great opportunity that's slightly outside our scope, we still feel confident diligencing it, like we want to participate to make sure we get it. But I definitely find the funds that are confident in their area and humble in other areas, that those teams tend to outperform where they don't veer too far out of their strike zone. What I view as a red flag when people claim expertise in multiple different vectors, like there's so much, like that's what why I find crypto enormously fascinating is it's really just a tech layer, but underneath it is all these different categories: energy, compute, music, social. It's like, how could you even try and claim that you're an AI and DeFi expert if you've been doing it for like 2 years like, maybe you're at like a larger crypto fund and now you're peeling out. Like, you don't know anything about finance. Like, unless you worked 25 years in finance, like you don't know anything about it. You know things about AI because, you caught virtuals early. Like, you don't really know anything about AI. So like that humility to stay in your strike zone and really own your category, be comfortable being a follower if there's the right opportunity, but really trying to stay within your strike zone is what I have seen to be a common thread of success.
There we go. Are you able to give an example of one of your, and you can kind of be vague, but a great investment, whether it be a direct investment, whether it be a fund investment, whether or not both?
Best investment. Yeah, I'd say betting early on a couple managers. I'll omit their names. It's always risky doing emerging managers because there's just not that much like proof in the pudding. But occasionally you'll see just like a diamond in the rough who's underappreciated, and maybe they don't have the same polish. They don't come from the same pedigree as someone who's spinning out of a fancy school, or who went to a fancy school and was at like a tier one fund who's then spinning out. I do think there's something to like really have been like forged in the crypto fire, and like they just live and breathe it. And like when you message them on Telegram, no matter what time of day, they're online. And it's because like they love this space and they just like know everyone. They attend every conference. They are like thirsty for crypto information. Like, we've made a few investments like that where just like that hunger just like really shine through, and they've generated performance far better than some of our investments where it's just like an extremely pedigreed person spinning out. So that has been an interesting lesson. Just look for like raw talent and hunger over necessarily polish and,
Resume.
brand names. Yeah.
Yeah. Yeah. No, that's what's so interesting and cool about the crypto universe is that it's so much of it is really self-taught. I mean, one thing is that it's so young and new that, self-teaching is kind of the way to go broadly. But I mean, as you mentioned, you can have someone who's, works at, I don't know, some regular day job, I don't know, is some office job, right? And then at night and weekends, whatnot, that they're deep and maybe probably even at work, to be honest, but they're just super deep and involved in TG and different groups and learning about different technologies and DeFi and whatnot, and people like that can really outperform. That's super interesting to hear, and I totally believe it. So very cool. So, and this is kind of I want to ask this question. It's a little bit comical because you just faced an extremely difficult situation 2 weeks ago, but can you describe a challenging situation that you've been involved with pertaining to your firm?
Yeah, absolutely. And I think the best disinfectant is sunlight. So I'm not afraid of sharing our failures. In our fund of hedge funds, we invested into a fund where this was back one of our investments in 2021. So back when we one of our first 6 or 7 investments, we invested in a fund that appeared hyper polished, referenced exceptionally well. We did good DD, and they were backed by a lot of good names. And you kind of have a gut feeling when someone is just a little bit off and maybe lying to you. And we didn't trust our gut because everything else seemed so amazing. As we were invested with them, our NAV statements on a month-to-month basis started to be produced slower. When we reached out to them, there was, hey, we're in disagreement with our admin on how to calculate NAV for this particular trade. Then that was okay, and we kept following up, and there continued to be just kind of weird energy and communication. And then we reached out to their admin, we reached out to their audit tax, and that we continued to just kind of flush out the situation. And ultimately, what we gathered was that there was some misappropriation of funds by the GPs, where they were doing trades and investments that were not at all within their thesis or what they outlined, and they had harvested some capital for personal gain without obviously providing any discretion. There wasn't even crystallization of incentive fee or anything like that. And one thing I'm proud of is that when we had the hunch that something was off, we withdrew 50% of our money and they actually sent it back. But the other 50% of money has been, the SEC ended up coming in, freezing all assets of the firm. One guy is on trial to go to jail. And it's been multiple years of working with a receiver to try and get as much capital back to LPs as possible. Because they had launched a new fund and they were taking money from one fund to, match redemptions for another fund. So that was extremely painful. And we side pocketed that remaining 50% and marked it to zero. But we learned a ton about it. And I'll toot my brother and partner's horn, Greg, on this, because he was like a hawk and caught it and has managed the entire receivership process on behalf of all the LPs affected.
Wow.
So we've learned a ton about that process, caught it on the chin, but now we know. And, I'm glad we had that experience because it was painful, but now we've learned a lot of yellow and red flags that we can suss out, and we feel no FOMO at all. We do not chase returns. If anything feels slightly fishy, or if the returns are too juicy, there's probably too much risk being taken.
Totally.
So for anyone that seems like they're flying high and above everyone else, look no further than Three Arrows.
Yeah. Yeah. So the lesson in that is essentially, trust your gut, number one. And then number two, would you say it's just, as you mentioned, if returns are super abnormal, then avoid that? Because they must be doing something extremely risky in order to achieve
Yeah.
that.
One thing that I should have mentioned, when things are overly a black box. So we were like, okay, what are these trades you're doing? And they were like, that's our secret sauce. We're not willing to share that.
Hmm.
And we're like, okay, like, can you provide us any details, like what you're doing to generate alpha in these returns? They're like, we're afraid if this trade leaks, like that alpha decays quickly. And we were like, okay, they have multi-year audited track record. Like these guys seem very polished. Like everything seems good. They have great LPs, but like you need to be able to see what's going on. And like I don't believe in the black box thesis. Like you're not the medallion fund. Like there's no reason for this to be a total black box. So lesson learned there. If something's a black box, walk away.
Totally. Okay, so speaking of service providers, what are the service providers that you guys utilize? Because I would imagine they're different than what other crypto funds utilize, because you guys are not. Well, actually, no. Take that back. You guys are doing some directs, so maybe they are similar. But how has it been being a crypto fund of funds working with service providers? Because I know for our multiple funds, it's always just been a journey, because this is again a new market, new ecosystem, and getting a lot of these service providers, whether it be tax audit, whether it be fund admin, et cetera, kind of up to speed at what we're doing, especially with involving NFT things. That was really difficult. How has it been for you?
Yeah, from our perspective, calculating our NAV, doing audit tax, setting up fund structures is actually pretty easy because our NAV, both on the liquid fund of funds and the venture fund of funds, is basically calculated by receiving NAV statements from each of our underlying funds. And then our admin, and ultimately our audit tax team, are able to tabulate everything based on the statements we've received. So we've now started to do some directs on the venture side. So we set up Coinbase Prime and we have valuation policy in place, but it's still pretty easy. Like we have not that many direct investments. Now, to make it a little bit more interesting, I've seen every service provider under the sun because we've spoken to so many different funds. We're invested in so many different funds. So we therefore engage with all their service providers. And I do find like NFT funds and funds that are doing things on the edge or more complex, like, back in the early days of DeFi, like getting accurate NAV statements in a timely manner was very difficult. And so that, initially our NAV statements, because we're beholden to our slowest reporting fund to generate our NAV statements, has been delayed. And that's something we need to talk to our LPs about. It's like, hey, we're a fund of funds, we're beholden to the slowest fund. And so we've learned how to kind of drill into that as part of the DD process. And we understand how each of these service providers work. And so we typically can get a sense of how all these service providers play their role within the broader fund ecosystem. And therefore, we know who's good, who's fast, who's accurate. And that's part of and that's one thing we try and help funds with is like, hey, you're with this admin, like, they just cut 20% of the staff and like, they're not that good. Like we suggest going with this one.
Totally. We should talk after. I need some. It's funny. I talked to a lot of managers, and I don't know anyone who's happy with their fund admin. Not that we're totally mad at our fund admin, but it's not easy. But anyhow, all right. So fundraising environments. How has that been for you? How is it? So I know 21 was obviously a crazy year. 22 kind of first half was great, and then FTX, Luna, et cetera, is kind of we were in the doldrums. Now, Trump just launched a meme coin, which is pure insanity. Our presidents, which is again crazy. Bitcoin breached over 100K multiple times. How are you thinking about fundraising?
Yeah, I'd say fundraising is a never-ending job. There's, the people who you're trying to close in the short term, and then there's just like relationship building. So the relationship building now with downstream larger institutional allocators is the best it's been in a long time. Everyone is curious and trying to learn more. trying to see what are the different funds out there, the different strategies, the different approaches, lessons learned, blah, blah, blah. Those longer term relationship conversations are happening again. Even back prior to FTX, there were still very few groups that were actively learning. Now there are many more that are learning. So that's good. I still think on the liquid side, very few institutional participants are diving into the hedge fund world. Just because it is still very volatile. LPs don't really understand how these tokens are valued. So like, how can hedge funds effectively do their jobs? Like, it just doesn't register with their traditional view of the world. And it also is so volatile. They are like, is this a venture bet? Doesn't really fit with our hedge fund book. So it's just hard to categorize. Family offices, I think, are getting closer to comfort on the hedge fund side, but it's still very much a learning curve. There's also the component of people feeling like they missed a trade. They're like, oh, crypto's super volatile. It's been on a tear the last 18 months, like probably due for a correction. So they're kind of watching that. And then there's all these like big, is a strategic Bitcoin reserve going to happen? Or then people are going to flood in and chase? Is it better just to own like a Bitcoin ETF? Like a lot of the questions that hedge fund managers receive, and therefore we receive as well, is like, should I just own BTC? Like, you guys have underperformed BTC. Why should I not just own BTC? And then there's a whole different array of ways to address that question. The venture side for us has been much easier to fundraise for because of, as I mentioned previously, quarterly marks, less volatile, known wrapper. It just feels like a more lightweight training wheel style mechanism of getting some exposure to the space. And so it's been our road to fundraising our venture fund of funds has been much easier than raising for the fund of hedge funds.
So looking forward, let's call it 5 to 10 years beyond, how would you like Scenius to evolve?
Yeah, I think we want to continue to offer multi-manager strategies. Some maybe like, our fund of hedge funds right now is high vol, high beta. Maybe we'll iterate and create a second product that's lower vol. And it's more like a market neutral fund of funds, aiming for better Sharpe ratio and good returns, or risk adjusted returns. Maybe there's a secondaries vehicle that we launch. Maybe there's an advisory business that we lean into because we have this interesting position of sitting in between venture and hedge. Maybe we flex our direct muscles a little bit more and do direct investing into some of the projects that we see are materializing from our venture fund of funds portfolio. So my goal is just eye on the ball, do things incrementally better every day, find a product that is differentiated, and when you know it's going to work, go full steam ahead at it. And so we did the fund of hedge funds for 3 years before we launched the fund of VC funds. And then we think we nailed the fund of VC funds, and that's going to be a good vehicle. So we'll have our fund of VC funds too. Maybe that'll have a mildly different strategy at that point in time. And we'll just continue to grow slowly but steadily. And, I look at Bitwise. Bitwise is, to me, the paragon of success. Granted, they focus more so on passive products. They have the fund of hedge funds that they offer. But I think that's a brand that truly dedicated itself to trust. Didn't go veer off the path. They stayed. We're going to do things high integrity, focus on education, build simple to understand products that don't take too much risk, and ultimately that works. So that's my plan. Just continue to build trust inch by inch.
I love that. All right. So how do you view the crypto asset class today? I mean, it's evolved even so much since you guys launched in 21. How do you view it today, and where do you think it's headed?
Yeah, I think the hedge fund industry is definitely going to become a hotbed of new fund launches and funds closing and dispersion of performance, and some funds being so heavily oversubscribed that you can't get in. And I think there's going to be a crazy dynamic going on there where we don't know who the top funds are going to be over the long term. Plus, we're going to see all the traditional funds, the Millenniums, the Man Groups, the Citadels. They're all going to enter the space once there's enough LP demand and capacity and volumes that make sense for them to do it, and that will totally change the dynamic. So I think there's a lot to watch there, and also just like all the service providers, counterparties, like there were a ton of blowups there 2 years ago. So as there's more demand, more participants, more capital flowing around, like can we ensure that the safeguards we have in place can sustain a bigger market? That's what I'm watching on the hedge fund side. On the venture fund side, part of why we did the fund of emerging manager VC funds is because what's interesting about crypto is some of those early funds, they had crazy distributions, and the GPs clipped crazy amounts of carry. And look no further than Fred Ersham at Paradigm. The guy made a ton of money off Coinbase and Paradigm, and now he left and he's doing longevity and biohacking. And so I think we're going to see a reshuffling of the deck in that some of these venture funds that have scaled to enormous size that have since had to either allocate to liquids, do a bit of a spray and pray, overpay for things. It's going to be tough to generate returns. I very much respect these funds, but will they be able to consistently deliver good performance? Especially because the GPs are already super rich and happy because there was all that DPI. So that, to me, is important to watch, is the reshuffling of the venture deck. Who is ultimately going to be the Sequoia, the Benchmark, the Founders Fund? That, to me, is not determined yet. And it may not be the brand names that we all know because they were just early. I think it's not enough to be early to crypto anymore because it's so competitive on the venture side. So who do founders love? Who has a great reputation? Who delivers immense amount of value? Who's hungry and in the trenches and sourcing opportunities? That, to me, is the mystery of venture, and that will play out over time. But we're looking for all the clues that we could get to really isolate who those top teams are, and then ultimately, that's what Fund of Funds is for. It's for access, and we think we know those teams. We're monitoring them, and we want to ensure that we always are invested with them.
Amazing. Alrighty, Ben, time for the rapid fire closing questions.
Let's do it.
All right. What is the best investment advice you've received?
At the end of the day, I think it just takes a lot of reps. And then once you've built the reps, trust your gut.
I love that. All right. What is one piece of advice you wish you could give your younger self before launching your firm?
It is going to take a long time, but it'll be worth it.
I like that. All right. What trends or opportunities that you think will kind of define the future of crypto investing over the next, we'll call it 10 years?
I do think there is going to be a on-chain world of asset management that will have many AI components to it. And I don't know if that's, firms that are built entirely on chain and managed by various AI strategies, and like quant strategies. That is something to monitor, and like how liquidity can be, how the typical fund structure and the liquidity hindrances of it can be altered by on-chain crypto economy. For example, if I'm an LP in a fund right now, I want to sell my position. I have to find a broker. I got to talk to a GP. Got to go through blah, 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 all this shit. Like, ultimately, there's going to be a marketplace for that. And it could be all permissionless. And anyone could maybe buy a piece of it, the whole thing. So I think tokenized funds on top of like AI, on-chain, crypto native strategies that are allocated to by legitimate allocators are some trends that I still think are very, very early, but there will be innovation. Lastly, another one that I think is interesting is the rise of private equity. So there are a couple strategies out there, not many of them, but there are a fair amount of blockchain-based businesses that didn't issue a token, but they're a good business. They service the blockchain industry with their equity. And I do think private equity firms are going to start snatching those up, enhancing them using traditional private equity tips and tricks, and then ultimately exit them. So I think we're going to see a lot more movement in those blockchain equity-based businesses. But then also, I think there's going to be crypto integrated as part of a private equity playbook for traditional businesses. So introducing stable coins on the back end if you're a business that has roots in a bunch of different countries. Like what does crypto do well? Maybe buying BTC on the balance sheet and getting a premium for that. Like what are like different things that private equity firms that understand what crypto does well could implement into their businesses as part of their operational enhancements playbook. And I think
Very cool.
that's a new innovation that's still very young to see that materialize and whether it actually makes a notable difference. But as the tech improves, I think we'll see it permeate different styles of investing.
It's very cool. All right. What does success look like for you?
Success looks like for me just knowing that what we do to the best of our ability. We maintain that mom and pop feel. You're always going to get a home cooked meal here. We never want to lose touch of our roots. And I want to have fun while I'm doing it and work with cool people and know that, there's the people who we back are people who I want to be doing business with for decades to come. So I think that's what success looks like to me.
Amazing. Ben, where can people find you?
You can find me on Twitter, Benny P. Jacobs. You could also find my podcast, Senior Studio, on Spotify and Apple Podcasts. I don't have a MySpace, but yeah, maybe back in the day you could have reached me there. But yeah, LinkedIn, whatever. Feel free to reach out. I'm very responsive, chronically online. So yeah, feel free to ping me wherever.
Amazing. Ben, thank you, man. Appreciate it. This is stellar.
Andrew, thank you so much. You're doing a great job at Sermian. And thank you for having me on and for this fun, useful distraction.
Amazing.